We've got the JSE trading lower, and really no surprises because it's the way we started and the kind of tone that's been set by global markets as well.
Most definitely, another red day, and as you say, certainly not surprising, maybe just a slight shift in terms of which sectors are taking the biggest pain, where yesterday we saw the financial stocks being particularly hard hit as a result of both higher than expected inflation numbers in South Africa, as well as the financial woes related to Europe. Today we are certainly seeing the commodity sector and the resources grouping taking the biggest strain, resulting from Chinese PMI numbers that came out and also the lowering of those growth forecasts by Ben Bernanke.
Of course, when it comes to the state of the U.S. economy, there's been some attention that's shifted over to the Postal Service, in that it's a department that will stop paying towards employee pension funds, and that being seen as a kind of a soft default.
Yes, I think it's actually quite an alarming trend that we see there. I think we found yesterday in the FOMC comments that Ben Bernanke was actually quite confident almost in saying that, there will be there's no QE3 on the cards, no further stimulus coming. And I think he was trying to say all the right things. But when we look through this and we look at what's actually happening on the ground, and I think the US Postal Service that you mentioned is a very good example of that, where we're finding that these near corporate bonds, or these parastatal entities such as the Postal Service, essentially starting to almost default in a soft fashion. Now, of course, they will defend this vigorously. They will say that is certainly not the case. What they are doing is they are halting the payments of the employer contribution to the fund, and they say they're doing this on the basis that they believe that they have overpaid to the extent of about $6.9 billion to the pension fund, and they are waiting for a court case to actually allow them to get some of that money back. They made a loss of $8.5 billion during the previous financial year, so one can see that $6.9 billion will go a long way towards alleviating some of their financial woes. But what they've done now is both to stop the payment of the employer contributions towards the pension fund, and they're also trying to stop or certainly reduce the prepayment of health benefits to retired workers. So these are the sort of small things that we see coming through in terms of reality for the man on the street in the US, where not only we know that unemployment is at very, very high levels. The job market is looking poor. Certainly the manufacturing sector is still not looking good. The growth is not coming through, and now you have this added to the scenario where even the support of your retirement fund and your health benefits is slowly but surely being eroded from you.
Of course, let's put this up against the likes of Greece, which has been getting most attention in this regard, because what the US situation or the Postal Services situation means is that it does have an impact on the quality of debt in their case as well.
Absolutely. When we think of the US situation, it certainly puts a pull on the credit rating of US debt. And obviously, we've seen some of the credit rating agencies putting sort of alerts out in terms of the rating quality of a range of US debt. But when we look at Greece, then the situation that we have there is, although there's been specific ratings downgrades on Greek debt instruments, the whole debate around whether Greece should be allowed to remain in the EU, whether it needs to be bailed out again, or whether it should be allowed to actually leave the EU, it starts putting a very different spin on things when you realize that not just the rating of the Greek debt, but also the classification of that Greek debt suddenly comes into question if they were allowed to leave the EU. The problem is that, of course, the previous debt that was issued in order to bail them out, and also that the Greek government has issued, qualifies as EU debt. So there's a whole number of not only companies and investment funds, but also governments, of course, in particular Germany and France, who own large chunks of this Greek debt, and it's currently classified as EU debt, and therefore has a certain allowable limits for them in terms of holding it. Should Greece be allowed to leave the EU, suddenly that classification falls away, and not only does it then change the rating status of that bond, but suddenly the value of it also diminishes quite dramatically, and that would be one of the very strong arguments arguments against the rest of the EU wanting to allow Greece to actually leave the EU at this stage.
Of course, it's the state of the global economy that's exerted the pressure we're seeing on the resources component. To what extent are you seeing a shift back into, let's say, interest rate sensitive sectors where we had those inflation numbers coming in South Africa, for example, yesterday, higher than expected, and that in many instances seeing forecasts shifting forward in terms of when that tightening cycle is going to begin locally?
Well, I think just if we contrast the sectoral performance from yesterday to today, there's certainly that theme that came through. As I said yesterday, on the basis of the Greek debt worries and European financial concerns weighing on the market, we certainly saw underperformance of the financial sector. Today, the financials, even though they're also in negative territory, the relative outperformers on the day, because we've now not only had higher than expected inflation numbers out yesterday, but we've also had better than expected GDP numbers. And now suddenly there are some of the market commentators that are looking at this and saying maybe that increases the likelihood that the Reserve Bank will increase interest rates, if not at its next meeting, then certainly sooner than previously anticipated. I think it might be a little bit premature to base that just purely on the recent numbers that we've seen, because I think the important situation is that the growth is still very tentative in South Africa, and we do know that the mandate has been broadened not only to look at inflation targeting, but certainly also to look at the growth and the job creation side of things. So I think probably a little bit premature to expect a rate increase. And of course, as long as these interest rates in the developed markets remain very low, the yield advantage that we will carry remains there, and South Africa will continue to attract capital inflows on the carry trade argument, which will keep the rand strong and will be on its own a deflationary measure into our economy.
Of course, the broad economic news that's affecting markets right now. When it comes to company-specific news, it's been pretty light, but we had Avusa out with numbers today reporting a 17% jump in full-year diluted headline earnings per share. What did you make of those numbers?
I think what we see in Avusa is that these numbers include 5 months of Retail Solutions, the new company that they brought on board. So we just need to put that into perspective as well. But certainly not a bad set of numbers. And I think what they are able to show is that the broad diversified strategy certainly is paying off, both in terms of their media as well as in terms of their print strategy. One of the things that I found quite interesting was to see within their books division how Van Skyke, in terms of the academic books, seems to have been a much better performer than exclusive books being a much more sort of high-end retail performer there. And I think the reason behind that is definitely related to the strong rand, where we're certainly seeing some price deflation coming through at the top end of the book spectrum. Avusa, of course, have entered into the online bookstore market, and they've certainly seen some very good initial growth, and I think that could be a very strong performer for them in years to come.